Cisco shares taking a hit in the pre-market after slashing its full-year guidance and announcing layoffs that will impact 5% of its workforce, amounting to about 4,000 employees. Yahoo Finance's executive editor Brian Sozzi is here to break this down for us. Give us some context here, Brian.
Yeah, well, unfortunately, I don't have much in the way of positive things to say about this quarter from Cisco, so let me just check through some of them. Really, everything you don't want to hear from a big cap tech company. Cisco served up last night on its earnings day, talked about slowing demand or worse than expected demand, an ongoing inventory correction which may not improve into the second half of this year, talk of large telecoms perhaps not really aggressively investing in their business until 2025. And then last but not least, Cisco came in here and said they will sack 4,200 employees to improve their profit margins because demand is in fact slowing. But don't take my word for it. Here's what Chuck Robbins, chair and CEO of Cisco, had to say about the quarter.
First, in terms of the macro environment, we are seeing a greater degree of caution and scrutiny of deals given the high level of uncertainty. As we're hearing this from our customers, it's leading us to be more cautious with our forecast and expectations. Second, as we discussed last quarter and subsequently saw in other technology provider results, customers have been taking time since the start of our fiscal 2024 to deploy the elevated levels of products shipped to them in recent quarters, and this is taking longer than our initial expectations. Third, we also continue to see weak demand with our telco and cable service provider customers.
All right, so the vibe on the street, guys, is that for the second consecutive quarter, Cisco really, I think, surprised a lot of folks on the street, resetting guidance, telling folks we cannot deliver up to the expectations we set previously. And there's some of those vibes on the street. I think the Jefferies team, I think it was Chris Nodder, really letting Cisco have it, noting on his second trip through the inventory correction confessionals. A very aggressive headline from the team over at Jefferies, and just critical analysis by their team. And then lastly here, look at this Yahoo Finance investor checklist. If you're waking up this morning, you see the top trending ticker on the Yahoo Finance platform, you see Cisco, you're trying to make sense of it. Here's your guide, essentially in 4 bullet points. Not a good quarter, like I mentioned. Not a good quarter, like I mentioned. Cleaner quarters will likely take time to emerge. That is me just using my analysis or my experience covering retail and applying to technology. When you have over levels or just too much inventory in any forms of channels, usually it takes 2 to 4 quarters to work out and margins to improve. And last but not least, remember, Cisco still has a $28 billion deal on the line in Splunk. If there's any positive thing here to say, they did note on the earnings call that deal might close a little earlier than expected by the end of the second quarter, might lead to that executive team coming out with higher guidance later this year to incorporate that Splunk division. But again, not a good quarter. And I have more context on this one on the Yahoo Finance Live Markets blog, not our homepage. I had a lot to say about Cisco and I had to get it out somewhere.
Well, you got it out here this morning, and of course they're on the blog as well. I mean, there was a lot to really chew on from that earnings call as well. You know, we wrapped this up, them saying it's going to be possibly 1 to 2 quarters away from full implementation of some of that inventory that you were talking about as well here. So
you can't just get rid of inventory magically. No. It takes a few quarters, even if it's on sale.
Brian Sozzi, thanks so much for joining us on set, breaking down all things Cisco.